Tesla didn't stall this week. It quietly changed how it survives and scales the next decade. Good morning, this is Ken. In today's video, I'm not just recapping Tesla headlines from the past week. I want to explain why Tesla moved the way it did, why the stock barely moved on the surface, and why this quiet week may actually matter more than most headline-driven weeks. If you're a long-term Tesla investor, this is about understanding the structure behind the noise, not reacting to short-term price moves. From January 13th to the 17th, Tesla's week looked uneventful at first glance. No flashy product launches, no explosive stock move, no dramatic headlines. But once you line everything up, this week wasn't empty at all. It was a week where several small strategic decisions quietly aligned toward Tesla's next phase. Let's start with Tuesday. Going into the week, Tesla had already pulled back from near the $500 level and was trading around the mid-400s and 40s. The key point here is not that the stock was falling, but how it was falling. There was no panic, no heavy breakdown, but it was clear that upside momentum had slowed. This told us something important. The market wasn't turning bearish, it was becoming cautious. With earnings ahead, investors were no longer chasing price, they were waiting. At that point, the most important technical level was around $430, not because breaking it would end the trend, but because it represented a patience test. Could Tesla hold without excitement, or would the market demand a deeper reset? My conclusion at that moment was simple. This was not a time to rush judgment, and that distinction matters more than most people realize. What's critical is that Tuesday's setup was not driven by bad news. There was no negative catalyst, no sudden loss of confidence. Instead, the market was digesting a lot of future expectations that had already been priced in. In other words, Tesla wasn't being rejected, it was being grounded. On Wednesday, several Tesla-related updates came out. Minor improvements to the Model Y, expansion of Tesla insurance, more corporate-focused supercharger deployments. None of these moved the stock, and that wasn't because they were meaningless, it was because they were hard to price. All of Wednesday's updates had something in common. They weren't about starting something new. They were about strengthening what already exists, improving core vehicles, making insurance more accessible, expanding charging for real-world usage. These moves don't create instant revenue spikes, but they reduce friction. They make Tesla harder to break and easier to scale. That's not exciting in the short term, but it's essential before the next major expansion. So Wednesday felt quiet, not because Tesla stopped moving, but because the market struggles to reward infrastructure-style progress. No hype, no simple narrative, just preparation. By midweek, the tone of the market was clear. Tesla wasn't accelerating, but it wasn't slowing down either. Then came Thursday. This was the only day the stock clearly reacted. The trigger was Elon Musk's comments about shifting full self-driving toward a subscription-focused model. The stock dipped into the mid-400s and 30s, and this point is crucial. The market was not rejecting FSD technology. It was reacting to a change in how revenue is recognized. Historically, FSD's one-time purchase created clear, immediate revenue. Subscription changes that. Revenue becomes gradual, predictable, but slower to show up in earnings. From a business perspective, subscriptions are powerful. From a short-term market perspective, they feel uncomfortable. That discomfort is what you saw on Thursday. Wall Street didn't sell confidence, it sold clarity. By Friday, something interesting happened. The discussion around FSD became calmer. Comments were divided, but not emotional. Some preferred subscriptions, others wanted clear conditions, some valued ownership as a concept. None of these views were wrong. They were based on different priorities and different time horizons. That's what healthy debate looks like, and the stock stabilized. So the real question is this: why now? When you line up this week's developments, a deeper pattern appears. Connectivity improvements aimed at fleet usage, vertical integration in lithium refining, a shift away from selling future promises toward charging for current capabilities. All of this supports one objective: keep FSD and eventually Robotaxi moving forward without regulatory or structural roadblocks. Subscription aligns better with reality, with regulation, and with continuous improvement. So here's the conclusion. Tesla didn't retreat this week. It adjusted how it moves forward. FSD subscription can be seen as defensive, or it can be seen as preparation, but judging by the broader context, this was not a step back. It was a way to keep going. Weeks like this don't excite traders, but they quietly shape the next 10 years, and for long-term investors, those are the weeks that matter most. Before we wrap up, let me take a moment to introduce myself. I drive a Tesla Model Y, and at home, I've installed a Tesla Powerwall, so I actually charge my car with solar energy. I truly believe Tesla is shaping the future, and that's why I share the latest news and insights here on this channel. I'm from Japan, but I want to connect with Tesla fans all around the world. That's why I also create an English version of my videos. YouTube now lets you switch the audio into your own language, so you can enjoy it in whatever language you prefer. Most of all, I'd love to connect with Tesla fans everywhere so we can support Tesla together. I also share updates on X, so feel free to follow me there and let's connect. And if you haven't already, please subscribe to this channel. I'd really appreciate it. Thanks for watching, and I'll see you in the next video.